$84 trillion is set to change hands over the next 20 years. Whether you're passing it down or inheriting it, the decisions you make today will shape your family's financial future for generations. Welcome to the Great Wealth Transfer, where David Pulcini, CFP, guides you through the strategies, insights, and pitfalls of navigating one of the largest financial shifts in history. What you don't know could redefine your legacy.
Welcome back to the Great Wealth Transfer. This is the Business Owner Edition, and we're going to start off with a quote like we always do, and that quote is this: family businesses are built on love, trust, and tradition, and they often crumble under those same three things. So think about that. Today, I want to address succession planning, especially when the business is family-owned. And if you're not a business owner, you probably know someone. Make sure they get this, because this planning is very important. But let's say you're a business owner. You've worked your whole life to build this thing. You don't stop thinking about it. You put your time in. You've created jobs, served your community, and maybe even put your last name on the sign out front. But when it's time to step away, who takes the wheel? And just as important, how do they take the wheel without driving the whole thing off of a cliff? So let's walk through a few true stories. These are real. These are folks that I've worked with that show just how fragile a business can become when there is no succession plan in place. And number one, we're going to call it Jim's family blow up. Very common, folks. It's unfortunate, but this happens all the time if there's no plan in place. So Jim built a successful construction business from the ground up. He had 3 kids. His oldest son, Mike, had been working in the business since he was in high school. His daughter, Sarah, became a teacher. And his youngest, Ryan, was in and out of jobs and spent a few years figuring things out, right? When Jim passed unexpectedly, his will split the business equally between all 3 children. No operating agreement, no clear successor, and no buy-sell terms, which we're going to cover later. So within 18 months, Mike had left. Ryan tried to step in, failed miserably to be nice, and Sarah wanted out altogether, right? She's a teacher. So the business was sold for a fraction of its value, and the family hasn't had Thanksgiving together since. So guys, what was missing? A plan, a conversation, a strategy that aligned the business's needs with the family's values. That's it, okay? Case number 2 here, we'll talk about Paul and Derek's partnership disaster. Again, another common scenario. Paul and Derek were 50-50 partners in a regional marketing firm. Great working relationship, strong growth, great friends, but no formal succession plan. Paul passed away suddenly from a heart attack. And with no buy-sell agreement or contingency plan in place, Paul's wife inherited his 50% ownership. She had no experience in the business and did not get along with Derek and never did and never will. So tension soared, decision stalled. Within a year, Derek had to buy her out at an inflated price just to keep the business afloat. Okay, so what could have been a smooth transition became a 6-figure legal headache and the end of a decades-long friendship. Okay. Case number 3, the retirement that never happened. Janet owned a thriving accounting firm. Everyone, including her junior partner Laura, assumed that Laura would eventually take over, but it was never formalized. There was no valuation, no timeline, no agreement. Janet unexpectedly got sick and passed away within 6 months. And with no documented succession plan, clients left. They fled the firm. And Laura, despite her loyalty, couldn't act quickly enough. The practice sold for pennies on the dollar, and Janet's family lost a generational asset. All right. And the final one here, we'll call it the key employee exodus. Frank led a manufacturing company and had 3 longtime senior employees who essentially ran the day-to-day. They weren't family, but they were loyal and expected to eventually buy into his company. But Frank never put anything in writing. When he abruptly sold to a private equity firm, these key people were not part of the deal. They felt blindsided and they left. And when key people leave, things happen. And within 18 months, the business collapsed under the new ownership. These are not rare stories. They're actually pretty common, and they're preventable with a real plan. So how do we do better? Let's break down the key elements of a real succession plan. Number one, ownership versus leadership versus employment. Too often, families confuse these three roles. And to break that down, ownership is who holds the equity. Leadership is who makes the decisions. Employment is who works in the business day to day. You can give someone ownership without giving them operational control. You can even set up structures where someone benefits financially without ever stepping foot into the office. So think of voting versus non-voting shares, phantom equity, which we'll cover in a different episode, trust with oversight clauses. Okay. Number two, what should we do? Succession isn't a moment, it's a process. Transitioning a business takes time, often 3 to 5 years or longer. It involves grooming the next leader, introducing them to clients, slowly transferring key responsibilities and documenting every process. If you are still the only person who knows how to unlock the safe, handle payroll, or approve major purchases, you are probably not ready to exit. Okay. Number three, let's get this in writing. Family handshakes do not hold up in court. Whether it's a buy-sell agreement, a formal operating agreement, or a succession roadmap, it has to be in writing. So let's talk about where people go wrong, even when they think they might be doing it right. We'll call it the fairness trap. This is the number one killer of family businesses, trying to make everything equal instead of fair. If one child built the business with you and the other two never contributed, splitting ownership equally can lead to obvious resentment, power struggles, poor business decisions. And fair, on the other side, might be giving the one child the business and the other's non-business assets, okay, or setting up a structured payout over time, okay? Not having the talk is something we don't do as business owners. So many founders just avoid the conversation. They assume the kids already know what's going to happen, or worse, they believe that revealing the plan will cause conflict. But here's the truth. Not talking about it causes more conflict later. Talk now while you're around, healthy and in control, all right? We all know somebody who's, they've hung on too long, and it's hard to let go. I get it. But clinging to power, refusing to delegate, avoiding documentation, micromanaging, it robs the next generation of growth and readiness. So if you wait until you're gone to make the transition, you've already failed. Okay. So what does a successful transition look like? Number one, involve third parties. Bring in a financial planner, a business consultant, an estate attorney, even a family therapist. Having a neutral voice keeps emotion in check and decisions objective. Number two, incentive structures. Creating those golden handcuffs, we've all heard of that for key employees. Let's define performance metrics for family leadership and implement a staged buy-in for family successors. Okay, make it easy on them and it's good for you. Plans for contingencies. What if the next generation leader wants out in 5 years? What if you have to sell? Build options into your plan so it can adapt to the unexpected. So let's do this. Let me give you the step-by-step framework and the next smallest step to take to do this right. Number one is just clarifying your goals. Identify when you want to exit, okay? Timelines obviously matter. Number two, decide how you want to exit. Is it a full sale, partial step back, transfer to family, or a number of other options it could be? Number three, define your personal financial goals post-exit. That's where an advisor can help. How much money do you need? Where's it going to come from? Okay? Step two, identify the successor. Who will run the business? Is it a child, a key employee, an external buyer? Okay. Assess their readiness. Do they need more training, mentorship, licensing, whatever it might be? Okay. We need to figure that out. Step three, separate ownership, leadership, and employment. We've talked about that. Decide who will run the business. That's the equity. Decide who will lead, CEO, president role. Decide who will work in the business, if anyone, right? Some of us don't need that. These don't have to be the same people, and they often shouldn't be. Different people have different skill sets, okay? Step four, draft a written succession plan. Work with an attorney and financial planner to formalize first a buy-sell agreement. I keep saying this. So I've said buy-sell a few times now, and I think if you don't know what that is, let me explain what that is in plain English. A buy-sell agreement is like a business will. It spells out what happens to your share of a business if something unexpected occurs. Like you retire suddenly, you pass away, you become disabled, you get divorced, you just want out. Any reason to get rid of the business, right? Or you're out of the business. The buy-sell agreement is a legal agreement between business owners that says this: who can buy your share, often the other owners, the company itself, or even a key employee, what price they'll pay, usually based on a professional valuation or a pre-agreed formula, and how they pay it. Oftentimes, this is done with life insurance. Okay, that seems to be the best way to leverage our money. You could pay cash, or it could be structured payouts over time. Many times when we talk about buy-sell agreements, financial advisors are talking about getting life insurance that is paid for by the company that will pay out if something happens to you or you want out, okay? And why does this matter? Let me give you a real example. Imagine you own 50% of a business with your partner. If you pass away, your spouse might become the new co-owner, like one of my examples earlier, even if they've never worked in the business and your partner doesn't get along with them. A buy-sell agreement provides that. It says, if I die, the business or my partner buys out my share at a fair value, and my family gets the money, not the business headaches, right? So how do we fund this? I just talked about this a little bit, but most well-run buy-sell agreements are backed by life insurance. So if an owner dies, the insurance pays out, that money is used to buy the deceased owner's share. So that keeps the business stable and keeps the family financially secure. So let's get back to what we should be talking about with an attorney and financial advisor, and we'll finish up our steps of what we should do. So we need to identify terms of transition, that business evaluation, how we're going to pay it. And I would also add in here, meeting with an expert in your business field to increase the valuation. I could do a whole episode just on this. If we can increase the profits or revenue with some easy adjustments, which is usually the case, think of the vehicles that might be for personal use that are on your business account or taxes, right? We all get it. I'm not the IRS. If your business is paying for things that could probably be switched over to the personal side, we should take care of that a few years in advance to then increase the value of the business. And then we can get a larger and higher value or multiple on the business, okay? Another step here, we're going to fund the plan and set up financing. So again, life insurance for buyouts. It could be a sinking fund or financing structure for internal sale. Key person insurance if you need it, right? And then we're going to communicate with the family and key stakeholders. Sit down with your spouse, your kids, and your employees to explain the plan. And I would document the why. Why are we making these choices? And again, that just minimizes that conflict later, okay? Then we're going to begin the transition process. I talked about 3 to 5 years. Ideally, it's going to take some time. I see 1 to 3, 3 to 5. Most of us, though, we just find a good deal and we sell, and we might not be ready, okay? We want to start this transition process, and we want to introduce a successor to our clients, our vendors, our advisors, and then step back gradually. Don't just disappear overnight. And if you don't just disappear, most times you can get more money for your business, okay? Then we're going to create a contingency plan. What happens if the successor backs out or fails? Happens all the time. Who's the backup to that person? Add these terms into the written plan and then review it annually. So we're going to revisit this plan each year, adjust it for the business growth. What if you get a valuation on a business and then you 10x your revenue? Things have changed, right? We need to revisit. What if there are tax law changes or shifts in family dynamics, okay? And then the last step here is when the time comes, we're going to exit confidently with peace of mind, knowing your business, your wealth, and your legacy are protected. So what does this take to get all of this started? I know this is a lot, and I'll tell you guys, you all know this. Business owners will say they do not have the time to do this. So it's probably an hour or two of your time just to get this started. And I would email, text, call your financial advisor, text them, email them, or your attorney. And if you don't have one, you can just shoot us a message. We can introduce you to the right people, okay? So here's the big takeaway. Succession is not about control. It's about continuity. It's not just passing on wealth. It's protecting the relationships that you've built over time. It's preserving that legacy that took decades to build, and it's giving the next generation the tools, the training, and the time to succeed on their own terms. So if you're a business owner and you've been putting off this conversation, which most of us do, today is the day to start. Don't let your life's work become tomorrow's family feud, because wealth without wisdom becomes a liability. but with a plan, it becomes a legacy. Okay? Subscribe, share, leave us a review. And if this brought you value, please share it. And as always, make it a great day.
Thank you for listening to the Great Wealth Transfer Podcast. If this podcast resonates with you, reach out to 6 Point Financial Partners at 585-485-6048 or email dpulcini at 6pointfp.com.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. All investing involves risk, including loss of principal. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. Information here is provided in part by third-party sources. These sources are generally deemed to be reliable. However, neither 6 Point Financial Partners, Private Client Services, nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of 6 Point Financial Partners. They do not necessarily represent those of Private Client Services, RFG Advisory, their employees, or their clients. This commentary should not be regarded as a description of advisory services provided by 6 Point Financial Partners or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives through Private Client Services. Member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory LLC, RFG Advisory, or RFG. A registered investment advisor. Private Client Services, 6 Point Financial Partners, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.